So let's bring that piece to a close. And by a show of hands, how many put the bulk of their money in this corner? By a show of hands, who put the bulk of their $1 million into this cell? So I've got a few. So I'm going to cold call someone now, and I want the short explanation, the 30-second explanation. And since I'm looking at this gentleman, why don't you stand up and give us the 30-second rationale for why you put the bulk of your dollars in there? Yeah, there's a mic. But we only want the short version, because I'm going to call on a lot of people now.
Hello.
Do it. Yeah, hold it up to your mouth.
Okay. So the short version is, I believe, at this stage more in the blockchain technology than the crypto asset. First, for the reason that the protocol is more important than the application layer. And second, because of the regulation. So I believe, for instance, choosing between the top and the bottom on the left, the key is regulation there. So we know what we're dealing with at the bottom, we don't necessarily know at the top.
Thank you. Okay, so there's one. We're going to keep going. So I'm going to come back to this cell if I have enough time and call on more than one. But who put the bulk of their money in this cell? Okay, so I think two people. So please, 30 seconds on why.
Gut feel. The lower level because there's less risk. And I'm not sure just that there's potential in it.
Okay.
But I do like what that gentleman said about the blockchains will stay there, and these crypto assets may come and go. So I'm now seeing there's some value in being on the left as well. So I think I would be spreading it.
Okay, now you're changing.
But I am changing, yes.
But it's okay. If there's one thing I've learned in 20 years as an angel investor and as an early stage tech investor, it's I get it wrong more than I get it right, and so does everyone else. The failure rate in early stage venture capital by the world's best venture capitalists is about 50 or 60%. The angel failure rate in America is about 60%. The crowdfunding failure rate, we think, we're not sure, is probably about 80%, and the incubator failure rate is probably north of 90%. So most of the time we get it wrong, and so you have respect for other people's view because they may well be the one that got it right, and you may well be right to be in that cell. Top right-hand corner, who put the bulk of their assets up there? Now, a lot of hands haven't gone up yet, so either you're all going to put your hands up in the top left, or you're not voting. So top right-hand corner. Now, I haven't chosen him. Top right-hand corner, just by a show of hands so I can see. All right, Henry, please, what's your rationale?
Well, I don't understand any of this shit. So I'm going to invest in the most risky stuff, the highest return, because basically I can't differentiate.
Okay. And top left-hand corner. Come on, that should be the rest of you, right? Not necessarily. There's another choice. There's two other choices. There's infinite choices. But there's a choice that says, I'm not investing at all. I'm holding on to the $1 million. And there's another choice, which is I'm going to be broadly distributed. But so who's in the top left-hand corner primarily? Okay, please, what's your rationale?
Well, the rationale...
Yes, it's working.
Probably you're on the better side of liquidity compared to the right side. As in, on the right side, if anything happens to liquidity, you just basically, you don't have a floor under your feet anymore. On this side, you could hope that in the future, you're actually bringing liquidity to some assets. You're actually bringing those assets closer to the end investors. So you're on the right side, sort of the better side of the story if you want to make the world better. And I completely agree with the point about regulation, but we could hope, and some regulators are starting to move on these points, that the market is going to move towards that direction because there is efficiency there.
Okay.
So it's probably a future, a long-winded sort of bet, but it's one I'd be willing to make.
Okay, thank you very much. So did anyone broadly distribute their million across all of the cells? Rustam. Sorry, I saw his fingers first. Rustam, please, 30 seconds on why you did broad distribution. Can we have the mic there?
Okay.
Well, anyhow, he put his hand up. So
I'll tell you the quick thought
Yes.
process, which was I was going to go with Henry.
can you put it up here?
I was going to go with Henry with the most risky.
Right.
Then Tallulah said blockchain is the protocol, so you should go with the protocol. And then we all saw the top, which said smart investors seek active, diversified investments.
Yeah, I tried to lead the witness.
And
I was waiting for someone to spot that.
So what we decided was, first of all, I don't know whether crypto assets can change onto a different protocol. I don't know whether new crypto assets might go onto a different protocol.
Right.
And I think that splitting it around means that you have the highest risk, because even if you have that protocol, you might get Bitcoin or a new one, which is the one that really makes the money. But of course, there is a risk of it being safety of investment.
Yes.
So that's why you'd have some in the bottom ones. And then you have two in the left because of what we said, which is that the blockchain is the protocol and therefore it's important, and again it's more safe on the bottom. So I think 25% each.
Yes. Okay. So I think we've already proven the point I want to make, which is in the world we understand of investments, almost 100% of wealth managers will give you the same advice. It is some allocation across public equities, fixed income, large cap real estate, and alternative assets. And then you look into the alternative assets, and it's hedge funds that are investing in private equities and fixed income. And the allocation percentages will roughly change, but basically they're the same. And increasingly, all of their public equity activity is ETFs, just bundled up in different formats. All the fixed income is rather concentrated, et cetera, et cetera. The REITs, blah, blah, blah. So they understand that world. And here we are, Singularity University, the world's most sophisticated exponential technology audience, stuffed with a bunch of extremely sophisticated financial services people that we also invited to attend. And we had an extremely broad set of views. And I think that's appropriate. So now I'm going to tell you my thought process, and I'm going to show you where I end up. But I'm going to highlight that there is no right answer. And this may not even be the right matrix. So the first thing, and so by the way, we are the most active investors, and we needed to answer this question for our own investors. So bottom left-hand corner, we understand exceptionally well. These are the drivers of superior returns in early stage investing. It's proprietary deal flow. You need to have unique access to great opportunities, a strong due diligence culture. You have to spend a lot of time understanding the team, the opportunity, the competitive set, the defensibility of it, the potential winning outcomes in a competitive environment, the exits, et cetera, et cetera. And you put a lot of time into thinking through that. You actively participate in the portfolio companies because presumably you and other investors bring knowledge, expertise, relationships, networks, and you try and turbocharge the company you backed to the detriment of all the other startups, because the failure rate is exceptionally high in every segment of emerging technology, because early on the barriers to entry are very low. Any entrepreneurial team can say they're launching anything, pretty much. You have deep expertise, and most angels and most VCs tend to focus on the areas they understand. You need tight relationships to follow-on investors, and you need massive diversification. By the way, because of the failure rate and the other half of that equation, which is 10% of the investments of a typical early stage investor will get a 5x and better and will drive 90% of the return, just mathematically, you need to have 40 or more investments to have a 95% probability of getting the expected return of the asset class. So even though that expected return is 30% plus IRR in America, you have to be very diversified. And that tends to be true across everything we're going to talk about tonight. So we start off with this. But then we say, well, wait a second, wait a second, this isn't a body of technology that we really understand even. This is new technology, right? It's 2008 vintage at best, right? Whereas TCP/IP and the internet is 40 years old. So you then sort of say, do these rules apply? I don't even know. So then we went back and we said, well, when did we last see a protocol that changed the world? And what did we learn? TCP/IP, the internet. It was a transformative protocol. We know that. We can't live without it anymore. It enabled a full stack of innovation. Many companies were formed. In fintech alone, McKinsey estimates there were 400 Silicon Valley fintechs. Only one of them, PayPal, still exists as an independent company. A bunch were sold, Ameritrade, E-Trade, for great exits and returns, but the failure was massive. The failure rate was massive. Everyone had a hot dot-com deal. Valuations went crazy and then they crashed, but a few big winners emerged to change the world, and without question, the world did change. And I showed you the list of the wealthiest people and the most valuable companies. Implications for investing in the dot-com period. When you go back to 95, you can all ask for copies of this from the Singularity team. The first thing was value was captured early. That's why the world's wealthiest people were the entrepreneurs that created the companies and then were the ones that weren't diluted out in the follow-on investing equation. Superior returns to the early rounds. The world's highest performing investors tend to be early stage venture capital firms, the superior ones, Sequoia, Kleiner, Andreessen, as well as a few private equity firms. Follow-on investing actually reduced the return, which was implied in the data I showed you before. If the return's going 32%, about 14% mid-stage, and 11% late stage, if you follow on invest, unless you're able to predict the future, you're actually going to reduce your return by following on as a strategy. So actually, one-time investing early is the superior strategy. Insider deals and circles won big. This is really important. There were 1,000 internet venture capital firms in America, or at least there are 1,000 venture capital firms in America at the time of the internet. Only about 50 of them have a unicorn. Sequoia has 30, NEA has about 25, Kleiner Perkins and Andreessen have about 20 each. 950 venture capital firms never got a unicorn. And the inner circle VCs helped each other. So Sequoia and Kleiner back at home and Excite, they merge them together and they sell them to a portfolio company called Yahoo. Those are the sort of deals that occurred. It's like SoftBank shows up at Uber and gets Uber to sell the Asian business to its own portfolio company in Asia. So the inside deals are very important. A few new blue chip investors surfaced, like Andreessen as an example. Access diminished over time. If in 95 you had wanted to be an individual investing in Andreessen, he would have taken your money and he would have honored you every year since, and you could carry on investing in his sidecar vehicle. But 3 or 4 years later, his minimum was probably 10 million. Sequoia's minimum is rumored to be 25 million, but they don't really want anyone's money other than big institutions anymore. So access diminished. There was a flight to quality after the crash, and the fund of funds that surfaced, the Horsley Bridges, the Green Springs, and True Bridges, definitely added value because they gave access to that inner circle. This just makes the point, just hammers it home, but I know it's not that legible for blockchain. 3 firms, Blockchain Capital, Pantera, Future Perfect, and I just mapped some of their portfolios. These are the unicorns of the blockchain age right now. Abra, BitPesa, Ripple, Coinbase, Brave, Blockstream, Blockchain, and Dela. So a small number of blockchain VCs are doing the same as Andreessen and Sequoia did back in the internet phase. They have moved quickly, and they have a large percentage of the blockchain unicorns in their portfolios, and they have the follow-on investment rights. So what does it imply for the blockchain? Well, I think the overarching guiding principles that should have guided the conversation, if I'd shown you them before, would be first, Avoid the herd. Avoid anything that has a high valuation, a multi-billion-dollar valuation for an unproven platform that doesn't know how to monetize itself yet. Avoid publicly shopped deals. If they're coming to you, why? It's probably not a good deal. Good deals don't get shopped broadly. Avoid unknown players. If you don't even know who you're backing, how do you know they're not a scammer? We know that 60% of the tokens issued since the second quarter of last year are already dead tokens. And a lot of them were abandoned by people that just took the money and ran. So scamming is definitely occurring in this time frame. And then avoid market timing strategies as a more subtle point, but dollar cost averaging is definitely a smart strategy. So instead, invest in early stage, whether it be equity or token, get in early. Get inside the inside circle. Be in the room where the deals are getting done. That's Hamilton, if anyone has not seen Hamilton. Try and get into the early emerging stars, but it's not easy to know which ones will actually be the emerging stars. So that's a difficult bullet point. Diversify like crazy, and this is a side point, but consider vehicles that give you diversification, because most of us don't have the resources to go direct and also be highly diversified. That takes a lot of capital. So these are the US lead players. Below the line are the general purpose funds, the big five that are in blockchain right now. The problem is they don't want individual money. Above the line and to the left of this line are the examples of the blockchain VCs, the top ones. There's a few others. And to the right of this line are examples of the crypto hedge funds, the and actually Pantera ICO is also on that side. There's a lot more, but these are at least the first cut. If someone's got a better list, I'd love to see it, by the way. So going back to this now, you all made compelling stories for why we need to be in your part of this matrix, and I don't know. I don't know what the right answer is. So I have a choice. I don't play at all, or I have a very large net, but I can't go fishing with a hook, right? So Alison and I have tried to create for ourselves a very large net. So what we did is we created a blockchain fund of funds, which is invested in the top VCs in that space. We're advisors and investors in Bitwise, but we would consider other when ETFs occur, we'd like to participate. Alison used to be CFO of BGI, which is now BlackRock, which is the world's largest ETF and asset management firm. And then we're experimenting with a cryptocurrency fund of hedge funds. So it's a fund of fund in that cell. And then we've done a handful of ICO token deals. But here, I don't trust my ability to choose them. So what I'm actually doing is I'm staying close to the top blockchain VCs. And when they back a company, for me, that at least checks a lot of boxes. And then if we can get in close to the same terms as the blockchain VC, maybe that's a token deal to consider. And then there's another category in that blue cell, which is value-added opportunities where we're bringing something to the table and we're getting token grants because of the value we add. That's not really an investor capital conversation. That's more of a service for tokens conversation. So that's sort of our strategy. I don't know if it's the right strategy, but what I do know is that that quote is actually true. Smart investors seek active, diversified investment approaches in rapidly emerging asset classes where smart people are disagreeing about what's going to happen in the future. And I think most of the exponential technologies that we deal with here at SU, this is still the right mindset. Look for diversification, be in the inside circle, let very smart people give you leverage strategies that get to the center, the heart of the domain of technology that's being worked. So this is how to contact me on the left. And this is Alison and I. Alison is here too. And these are our vested interests. So just to be clear, we do have vested interests in this story. And I'm announcing that because you can then, as investors, decide if you really believe anything I said or whether I was just self-servingly showing you the things that we're involved in. So that's everything, Mitesh. Did you want to do Q&A, or are we out of time?
Yeah, so maybe we can get some questions from the audience. It's really popcorn.
It's free and there's not much value in it, with a lot of value in blockchain potentially. A lot of value in blockchain potentially. Do you see the emergence of a single protocol? And if so, won't it be regulated as a monopoly?
Yes, I think that's a very good question. I don't think there'll be very many. So every time we've had technology wars, and where we've begun with a lot, we've ended up with less, right? And the functionality, meanwhile, has grown to absorb many things that we once thought were unique and distinct. So you and I, being similar vintage, we remember that there was this thing called the Apple IIe, but there was also the apricot. No one else in this room remembers the apricot. But there was the Commodore, and there was the PET, and there was, you know, my first computer when I went to Stanford with you was my AT&T Olivetti. Neither AT&T nor Olivetti are in the computer business anymore. So a proliferation of computers got crammed down. We saw the operating system wars, the mainframe wars. What we tend to see, and those they're not technically protocols, but they're bodies of competing ways of doing stuff with technology, and I've seen them diminish. Alice and I were investors in Inktomi. There's no one in this room that remembers Inktomi. Inktomi was, this gentleman does, Inktomi was the world's best search engine, bar none, and it drove Alta Vista and some other popular engines. Google came along and killed it, but there was a proliferation of others. They all went away, and now we have Google, and we have Bing, and is there another one? I know. So there's one in China, there's one in Russia, there's very few. So it's a long answer to your question, Andrew, but but at the same time, what's different here is that this is software. So the bundle of attributes in each of these protocols is a choice. And you can create, and they're working on a stack. So Bitcoin is a very broad protocol focused on identity and trust. Smart contracts is sort of a little bit narrower and a bit more targeted. And now people are coming out with sort of point solutions, if you will. My personal view is that over the next 10 years, we'll metastasize and have many, and then we'll collapse back to a few. And the challenge is, I don't know which are the winners. And I don't even know that Bitcoin is a winner. I actually don't know. So Bitcoin has huge brand awareness, global network, massive, you know, fundamentalist supporters in the room, but so did DOS, and it doesn't even exist, so I don't know. And then your other question about monopolies, well, I think that's sort of like the Google conversation of right now. The functionality is so clear that you have to be very thoughtful before you blow it up, and the EU may choose to, but I think for the most part, where the world is shifting in a positive way very fast under the power of technology, and so I think that the net gain is more than the net loss, but the wealth is being accumulated in a few pockets for sure. Another question. I can repeat it. Okay.
Hi.
Oh, sorry.
Sorry. Greg here from the London Block Exchange. It's slightly more of a question around token investing. But how do you counter in the effect of Bitcoin clearly leading all of the others in regards to price fluctuation?
Of volatility?
Yeah.
Does it lead the world in volatility?
I would agree. I would argue it does at the moment, I think.
I actually don't know if it does. But you know, volatility, well, when like-minded people all agree that on the value of something, and when it's massively held and broadly held, then the volatility goes away. But in concentrated, imperfect markets where smart people are disagreeing about whether this is real or not real, it's valuable, it's not valuable, we'll use it, we won't, I would expect to see a lot more volatility. I think that there are reasons why we've seen downward pressure in this time frame on some of the larger crypto assets. Some of them like ETH. It's because a lot of ICOs were done, a lot of startups got Ether, and they needed to get fiat currency to pay their teams, and so there was downward selling pressure from all of the ICOs that occurred in the first half of this year and the last half of last year. With Bitcoin, my belief is probably there's about 1,000 people that own the vast majority of Bitcoin in the world, and I think they're pretty sophisticated people, and they've got selling strategies, and they will sell as they can when, on the ups and downs. And then there's others that were hot and now they're not. There's a top 10 crypto asset by value, and there's no developers working on it. You can look it up. And so you sort of say, whoa, my gosh, people still think it's got huge value, but no one's working on it. How can it even be a protocol? But it's there in the top 10 list. So I think we're in the first phase of a game. And for investors, that's good, right? Superior, we were told, all of us at business school, in our economics, at Selwyn in the economics faculty, we were taught superior returns only occur in inefficient markets where information is not broadly and commonly held. Therefore, imperfect opportunities present themselves and smart investors grab them. As soon as markets become efficient, superior returns go away. So the other half of your conversation is it's a good opportunity for investors that can be on the winning side of this conversation. There was a question of a cluster of questions.
Looking at disruptive markets, I've been looking at health records where
yes.
a lot of the software is still written in COBOL.
Yes.
Remember COBOL?
Yes.
What do you think about for the early day investors using tax leverage, using a 1982 thing which is now called EIS, to get a rebate to de-risk at the front end and a tax-free exit at the end for UK residents?
Yes. So that's a pretty complicated question. So so at Singularity, we believe that the world is heading into a phase where some very big challenges are not going to be solved by today's ways of doing business. And in fact, the way we do things today, broadly defined, cannot scale and solve the challenges our children will face. So the only solution is innovation and these new technologies. So governments around the world are getting on board with that theme. And so the year before last, Google had me go to like 18 countries to talk about innovation and hubs of innovation. And I tell you what was profoundly interesting to me was that every national industrial plan in every country in the world has on the top 3 list, we will be a powerhouse of innovation and we will build digital hubs in the following areas of technology, and there's almost 100% overlap. It's IT, life sciences, and pick a third. So what this means then is that if governments believe that, if governments believed that they have to be innovation-based economies, and to change the world to be a better place, they have to stimulate innovation, then the vast majority of the tools at their disposal would be directed at stimulating innovation. They're not. It's a rounding error. EIS is a rounding error. It's deplorable that the British government would only give that much capital to stimulate innovation in the UK, and in the US it's even worse. The tax benefits to early stage investors are de minimis. But I think there'll be more. So said another way, the role of government is to stimulate the direction of society in the direction that those wiser people believe makes sense for us, who they represent. So I do think we'll see a lot more money flow, and I think EIS is a good start. But it's tiny. If you look at the data, the City of London, you see where's all the trading and where's all the capital going. It's not going to emerging technology in the UK. It's going to a lot of other places. So a lot more can be done.
So shall we have the last 2 questions, and then enough time for networking and drinks and chatting with your neighbors?
So Mark Zuckerberg obviously has a team dedicated to blockchain applications. To what extent do you think that the FANG stocks and their sort of Chinese equivalents are still innovative enough internally to be able to make these advancements, and where do they fit in to this?
Yes. So Alison and I wrote a book on this topic called Corporate Innovation, and you can find it on Amazon. We looked at the five, so Amazon, Apple, Google, Microsoft, and Facebook. And we looked at how they do innovation, and it's in the book. It's just an empirical study. I think what those 5 companies understand very well is that there's no monopoly on innovation, and innovation occurs on a global basis. So I think that what they have become very good at is leveraging the world's innovation to their own benefit. And that's everything from joint ventures and partnerships and developer ecosystems and a whole raft of tactics that they utilize. So the question of, if by your question you meant, do I think their homegrown innovation is the best in the world, we could have a discussion about that. And so long as there's no one from Google in the room, you know, most of Google's biggest breakthroughs were acquisitions, right? After they did search, you know, YouTube was an acquisition, Android was an acquisition, Gmail, I can't remember. Was it internally grown? Okay. So, but I think I think my point is still valid, which is they've been very good at bringing innovations in from the outside and scaling them up. But they should, because they're a very large company, and they don't have to monopolize and invent everything at home. They can tap the world for the innovation. So I think the 5 are very capable, and I think they're doing that. And I think that's the role they should play. And so I think that they're probably being very smart about this.
Okay, so time for one last question.
Yeah, thank you. The previous winners from the previous iteration when we saw things similar to this, they all came from California. The big promise of blockchain, one of the big promises is that it's going to be more distributed, more decentralized across the globe.
Yes.
Could you talk about where you see this being, what you think of the distribution geographically? Are the big winners, where do you think they're going to come from?
Great question, great question. It really is a great question. And I don't know the answer, but I've been thinking about it. And if there's a PhD in the room, maybe they could write a PhD thesis on this. All the businesses we're seeing launched in blockchain, all the white papers, make a claim that they're going to create a powerful, global, technology-enabled business. But when you scrape the surface, the teams are very focused on the technology. And most of them don't understand how to make a powerful global business. And so you have something like Coinbase, and there's no customer service, right? As an example, you can't ring up anyone at Coinbase and get anything solved. And I just use that as an example. Most of these blockchain businesses are going to have to feather into existing industries and businesses and propositions, and that makes it complicated, and that means that a lot needs to be created too. Theoretically, anyone in the world can begin that dialogue, but it's easier if you're co-located with the other players that are going to need to be leveraged to deliver powerful global, you know, technology-based businesses. And it happens to be true, therefore, that there's a bit of a competitive advantage if you co-locate yourself close to one of those hubs. Now, that's not just Silicon Valley. There's Shanghai and Shenzhen and Singapore and maybe London and Berlin. So there are some hubs. But believe me, it isn't Malta. Right? The British government, for hundreds of years, has been very good at taking British territories and giving them the freedom to modify tax and financial policy to give themselves raison d'etre in the world at large. And so we have Cayman and Bermuda and Bahama and Jersey and Isle of Man and so on. And Gibraltar and Malta now wanting to play that game in blockchain. But I think the center of gravity of the innovation and the hubs of these decentralized ecosystems are going to be somewhat concentrated. This is just my view today. I think the bigger question, which I have no answer to, is if you were creating a powerful global technology-enabled business, how would you leverage a decentralized ecosystem to do the work? And we used to write, back in our, 20 years ago at McKinsey about the virtual organization. And that really became offshoring and outsourcing. So I was with a team today, I won't name them, and they're going to serve a global industry. And I said, what's your business development strategy? And they said, well, we've got one person in London, we're going to hire one in New York, and we got one in San Francisco. And I said, you just had 5,000 people buy your tokens. Why don't you ask the 5,000 people to go and sell your product? Well, I think the power of decentralization ought to be that. The token and the motivation that it enables should allow you to get your work done through other people. Linux proved that that could be done in technology development. I don't know how it applies to HR and finance and logistics and all those other functions that a global business needs. So I think there's a book there. I think if anyone wants, I think that Reid Hoffman just did blitz scaling, but I think the bigger question of how you leverage decentralized communities to do all of your work for you is a really big, unknown field.
Actually, there's
Please.
an example in California. It's called Hyperloop Technologies.
Oh.
Yeah, I'm sorry for that.
Yeah.
And they first developed all their, using many different engineers, lawyers, and so on to get to the level where then they are starting to put together the train. But
yes,
it started
I think the
that
difference is that when you're at scale, how would you operate a global business with 4 billion customers when you're not doing most of the work and your community does that work? And I don't know, no one knows the answer to that question.
It's going to be an adventure.
Yeah. So thank you very much. A plug for SU. I don't know anyone that doesn't like being part of SU.
We're very grateful for this space that we get offered to hold these sessions. And thank you all very much for coming and attending. Thanks a lot.